All right, I need to do some year-end trading in my kids' accounts. I have a very specific strategy I use for tax purposes in my kids' custodial accounts. Custodial accounts are also named UTMA or UGMA accounts. These are accounts in which any income or capital gains all gets shown on the kids' tax return, and then of course over certain levels it would then pass up to my level. So I have a very specific strategy to keep taxes low. And I thought, while I'm in here doing this, I do this at the end of every year. Today is December 13th. While I'm in here doing this, I might as well just let you all listen along and see along. So this is on YouTube as well. So as I walk through it, I will explain it well in just verbally here. But if you really want to understand it, visuals are so much better. And I did screenshots with arrows and circles and all these things. And of course I was thinking, yeah, I can hop down in the basement, record this episode and get ready for it in 15 minutes and record it for 20 or 30 and back up. And here I am 2.5 hours later after all those screenshots and walking through the trade itself and making sure that it was very clear. And, that's just the way it goes. But hopefully this helps you. I really hope that you can walk into a trade, make it, and not get stuck and not be intimidated. I get this all the time. I get a lot of instant messages or direct messages that people are just intimidated by finance in general, especially placing trades. Now, a lot of firms have made this easier. A lot of firms have found ways to make it more intuitive because it has been in the past very unclear. So I used to work at Fidelity Investments, and the entry-level job that you get at Fidelity Investments is providing stock quotes and potentially helping people through trades. You got a lower rate. It used to be like $9.95 when I started there, and if you placed it online, or well, and this is the higher tiers, and you had to place a certain number of trades per month to get that low rate. Otherwise, you were paying something like 30 or 40 bucks online. But if you had a representative place the trade, it could be as much as $50 to $100. So all of the individuals that had money with these discount brokerage firms really had an incentive to place online. And frankly, the brokerage firms didn't care. They wanted us to help them place it online too, because if it was expensive to pay an employee, 10 to 20 bucks an hour to sit there and walk an individual through one trade online, because sometimes it took people a while. But anyway, so we spent a lot of time training people on order types and conditions and the different ways of placing orders and the strategy around that. So today I'm going to go through that with you, and I've made some slides. I don't know how pretty they are, but they'll get the job done. And so if you want to hop on YouTube, you can watch this as well. And I'm going to start sharing my screen. So this is placing your first stock trade. So first of all, the reason I'm placing trades tonight is because, well, it doesn't have to be tonight, but the reason I'm placing trades here in December is because I have a very specific strategy with my kids' accounts. If my children show more than $1,100 of unearned income, I have to report that on my tax return. And I am so lazy, I do not want to report this at all on my tax return, or I don't want to file a tax return for them. I just don't want to have to think about it. In fact, I wanted to use 529 plans just because all the taxes are deferred and potentially tax-free if you use them for college. But a UTMA or UGMA account, a custodial account, it can be used for anything. It doesn't have to be for college or education. And so my wife wanted those. So naturally we did custodial accounts. And so now my goal is to try to mimic the effect of a 529 by showing some gains under 1,100 per year, but not more than 1,100 per year. And what I'm getting out of this is complete tax-free growth, because if I show about $1,000 worth of gains, I don't have to report it, I don't have to deal with it, and it basically just evaporates in terms of tax filing, which is nice. So this is publication 929, and of course I had to look this up again. because I wanted to make sure that it really was still 1,100. There are multiple different levels. If your child actually has earned income, then some of these rules change and the amounts change. There's a much higher limit for earned income. But unearned income, this is like dividends, interest, capital gains from an investment, that's down at 1,100. So I took and whited out as much as I could of my own account numbers and things like that. But this is literally my oldest child's UTMA account that I'm showing on YouTube here. And she has about 4 or 5 different funds in it. And I'm trying to show $1,100 worth of gain. There's one position in there that's the total stock market. It is symbol ITOT, and it's the iShares total stock market. So thousands of stocks, has large companies, mid-sized companies, and small companies. And there's about $2,000 worth of unrealized gain. That just means that it's gone up $2,000 worth, and I haven't sold that position. It's about a $5,000 position. So something interesting, just as a side note here, as we talk about this, this account has been in existence for about 9 years, nine and a half years. And about 9.5 years ago, it was July of 2011. And that sounds about right. July of 2011, we were putting in $50 a month into this account. And we just kept doing it. And basically just forgot that it was happening. But it comes out of the bank every single month, $50 a month. And these accounts are not huge. I'm just going to show the cards here. These accounts aren't huge. I actually don't think that people should overfund college and sacrifice their own retirement savings. You can get loans for college, which heck, they might even be forgiven here with the new administration, but you cannot get loans for retirement. So don't go out and sacrifice your own retirement planning for your kids' college. But with that being said, my wife and I still want to put money aside for them. And we put in about $50 a month. And that has worked out to be almost exactly $5,000 right now. So it's pretty interesting. This account is worth about $8,500. So there's $3,500 worth of growth in it. If you look at the major market indexes here on the screen, over the last decade, the S&P 500 is up about 14%. Average annual, which is kind of crazy. And then if you look at the Dow Jones total stock market index, about the same. Russell 2000, that's small companies smaller than 5 billion approximately in size. They are up 11%, which that's not usual, by the way. In a really good positive market like this, you would have expected smaller companies to do better. And what we've seen in the last 5 to 8 years is these large tech companies have just boomed, just expanded like crazy. Think Facebook, Microsoft, Google. They have just blown up and become huge, and they're driving the large companies' overall growth. And international just really hasn't done that great over the last decade. International stocks are up 5.3% average annual. Bonds are up about 3%. So once again, not that great. So, well, I say not that great. I mean, bonds do their job, but for my kids, bonds were not the right place to have investments for that last decade. So we had mostly everything in stocks, and I had international, small cap, and then mostly in the total stock market index. So the return between those three was 5, 11, and 14. So our return was right in the middle there as well, which has been great, So again, it's put in about $5,000. The account is now worth about $8,500, but this is the balance as of November 30th, so $8,200. I'm mostly just showing you this because, one, it's not anything to brag about. This is not a home run. This is singles and doubles. This is hitting base hits, and it just worked, and I didn't have to think about it, and it was pretty easy to make that happen. And $50 a month is not insane either. Now, if I continue on this path, and we keep contributing $50 a month, then my 12-year-old daughter, when she turns 18, will have almost $20,000 in that account to start college. That's not going to pay for everything, but that's going to be a pretty dang good start. And I'm pretty excited about that. I actually don't want to pay for everything for her. I'm hoping to make it a little bit difficult for her, but just help a little bit here and there. This could also go, let's say she doesn't use it for college, because it's a custodial account, could help pay for her wedding, could help pay for anything else if she decides to go abroad, serving mission, anything like that. It could help pay for just about anything for her. I had a trainer back when I was learning about these long time ago that said you could buy a cheeseburger for her as long as you can prove that that money went to her. Now, something in preparing for this episode, something that really just hit me hard was this 6 years until starting college. That was hard. That's hard to swallow. I didn't realize that because I've been investing this in my mind as of literally less than 2 hours ago. I'm thinking, yeah, we've got more than 10 years, right? I mean, there's more than 10 years before she'll go to college. And I realized that 6 years from right now, she should be, if she goes straight into college right after high school, she would be in her freshman year of college right now. And it's somewhat freaking me out. But anyway, so the goal here is maybe I can take some of those gains that we would have to pay taxes on later if I sold the whole account, and I can sneak them out at under $1,000 a year. So that's my goal. So the other way I achieve this goal is I try to buy funds that don't require a lot of rebalancing or trading. By buying the entire stock market in one fund, it's not going to require me to go in and place a bunch of trades. This is a really small account, so I don't need to get too cute with it. I don't need to be too fancy. I mean, this one fund is going to work really well. And then I also try to buy funds that don't pay a lot of dividends or distributions. This account has had $80 worth of dividends and distributions and income throughout the whole year so far. And we're midway through December. Now, towards the end of the year, a lot of funds do spin off a little bit more in distributions, but I don't expect it to be a whole lot more. I'll talk a little bit more about exchange traded funds in a minute, but they tend to produce less dividend and interest and capital gain distributions than straight up normal old school mutual funds. So the other thing I'm trying to do is, again, I've mentioned this, I'm trying to sell the right amount to stay under that $1,100 limit. Call me lazy, call me crazy, or maybe it's just genius. I don't care, because it's going to avoid a whole bunch of taxes on these accounts. They'll basically come in tax-free over time if I can manage it well. So we're going to dive right into this. I am trying to place an order, and these accounts, most of my assets are actually at TD Ameritrade. These accounts are at Fidelity, where I used to work, and I just keep my three kids' custodial accounts there. So I'm going to log in as well on my other screen and place this order while we're talking, so you can get a feel for the time here of how long it takes. So I just logged in, and I'm on my home screen on my other screen, and then there's a trade button up in the top left. I'm going to click on the trade button, and I'm going to get this exact window that you're looking at. The first thing we have to decide is, what type of transaction are we placing? And I guess in all fairness, I had to click on her account out of the three, but I clicked on her account, and transaction type is stocks and exchange traded funds. So real quick, let's just pause and talk about the difference between an exchange traded fund and a mutual fund. An exchange traded fund is a fund that trades between participants in the market. And a mutual fund, well, let me take a step back even further. A fund is a basket of stocks or bonds typically. So you have, instead of buying one stock, you might be buying 500 stocks all at once. That would be like the S&P 500. You could buy all 500 in one symbol, one fund, just by buying it once. And that's a great way to be diversified. This is what I'm doing in these custodial accounts. So an ETF, an exchange traded fund, is a basket of stocks or bonds that's trading as that basket from individual to individual inside the marketplace. Exchange traded funds are newer than mutual funds. Mutual funds have been around for many years prior to decades prior to exchange traded funds. Mutual funds are typically purchased and redeemed from the mutual fund company. So instead of me saying, I'd like to buy this S&P 500 fund from BlackRock, I'll just go out, and BlackRock is they call it the sponsor. Then I'll just go out and buy it out on the exchange from another investor who happens to own it and is trying to sell it. That's not how mutual funds work. If I wanted that fund, I would need to go to the sponsor and say, hey, sponsor, I want to invest $10,000 in this fund. And you'd send them the $10,000. You would be purchasing the fund. They would issue new shares to your account, and then they would buy investments inside the fund. And then when it came time for you to get your money back, you would say, hey, I want my $10,000 back. You'd ask for redemption. They would then sell things off inside the fund, generate the 10,000, send it back to you. That's a mutual fund. It typically, in my opinion, at least from what I can tell, creates a little more drag because there's more transactions needed. You see all the redemptions and purchasing happening in a mutual fund requires that manager to be buying and selling, maybe not when they want to. And if we're just saying, well, if I want to sell my basket, does anybody else out there want the basket? You could just sell the exchange traded fund to somebody else. Doesn't require as much selling inside the fund to redeem that cash. So stocks and exchange traded funds can sometimes look the same because their symbols look really the same. I'll show you this here in a minute. The first thing you do is you pick the transaction type. And I'm just going to think about these two for a minute. I'm really trying to simplify this. I have a good friend who calls it Sesame Simple, and I think he listens to the podcast. So that's to you, my man. But hopefully I'm okay to use that. All right. So the symbol here, the symbol, they follow patterns. And a symbol is basically a ticker is what they call it. It's a symbol that represents a company or a fund. Mutual funds have a pattern of 4 letters and then an X at the end, A, B, C, D, X. And money market mutual funds typically have 2 X's at the end. So A, B, C, X, X. And the ABC, of course, I'm just making it simple here, but ETFs and stocks, stocks oftentimes are maybe just 1 letter, or maybe 2 letters, or 3 or 4. So like Facebook is FB, AT&T is T, if I'm not mistaken. And then you've got 3 symbol ETFs like SPY is that S&P, the largest S&P 500 index fund. So SPY is a fund while there are 3-letter stocks out there. So that's the only that's like the main tricky part about ETFs and stocks is sometimes they can look the same, but usually you can tell pretty quickly by the name if you're looking at a fund or if you're looking at an individual stock. So on the left here, if you are looking at the screen, you can see I've put in ITOT. That's the symbol for the iShares Total Stock Market Index. And again, this is like 3,000 to 5,000 stocks in there, small, mid, and large. It's working out great. And that's the first step. So you just put in the symbol. Next step, action. So most of the time, well, shoot, my slides are off. Yep, it's late at night. I'm just going to explain this to you. Don't worry about the right side of this chart. You have buy, sell all shares, or at Fidelity, they have specific shares as well. Everybody's format and user experience is a little bit different between TD Ameritrade and Thinkorswim or Fidelity, Schwab, Robinhood, and all the others. But the main thing here is you've got buy and sell. The sell all shares, that's just convenient, so you don't have to type in the number of shares. But literally, action is just buy or sell. Let's move on. So in this case, I actually said I wanted to sell specific shares. And I said, I'm actually doing it as we speak. So let's make sure I've got that in here. So I've got action and then sell. And I want to sell 24 shares. In the chart, it shows 25. If I sell 25 shares, I'm probably going to see and have to show a gain of $985. I wish it was $985,000. $985. Right now, this account has about $80 of income. So that would put me at $1,065. That's a little bit too close for comfort. And again, I know this is lazy, but I just really don't want to have to deal with the filing requirements of this. And what I mean by that is I don't want to pay the accountant to do it in the spring. So in other words, I'm going to reduce this a little bit by selling 1 less share, and I'm only going to do 24 shares. That's it. So moving on, you're buying or selling. And now we're going on to order types. So order types, there are 8 in this list, and this view will be a little bit different based on each brokerage firm, but order types are going to be like market or limit or stop. Those 3 terms, if you can figure out those 3 terms, you'll be in great shape. A market order is at the next available price. If you are trading and the market is open, that's going to happen within like not only a second, probably within a split second. That will delay more on your own internet connection than on the actual process to get that order through the stock market. It is insane how fast this is happening these days. So when you push the button, usually by time you have refreshed your screen and go to your order status, you'll be able to, at that moment, already see what it sold for, at what price, at what time it'll be done. Now, if the market is not open, the next available price will be the first price when the market opens. So as it's Sunday night right now, if I place a market order, I'm going to get whatever price happens early Monday morning. And I don't know what it is, if it's like the conservative nature of working at Fidelity. Back then, they were just adamant about try not to place market orders overnight. And you can see why. I mean, imagine you place a market order to buy $2,000 worth of a stock, but for whatever reason, they had some great news over the weekend or something happened. I mean, well, let's talk about like a vaccine stock, and they have these great improvements on the process or the delivery or the production of the vaccine over a weekend, and all of a sudden the stock triples in size, and that order's sitting in there ready to go. You actually just spent $6,000 on buying those same shares rather than $2,000 on buying those shares. So that's one of the main reasons you don't want to be necessarily placing market orders outside of market hours. And a limit order can help you. We'll talk about that. I'm going to place a limit order because it's outside of market hours. Now, because I'm selling these number of shares, my biggest risk is if the market drops a lot, but that's not a huge, I really don't expect that big of a drop on an overnight, so it wouldn't really impact me much. But anyway, I'm still going to place a limit order just to explain this. Okay, so a limit order says, I want this price or better. And depending on whether you're buying or selling, better could be higher or lower, right? So if you say a limit sell order means, like in this case, this particular fund is at $84.35. That's what it last traded for when markets were open. So if I say I want to place a limit order to sell this fund, I'm doing this right now. So I'm going to sell this fund at $84.50. So I'm actually about 15 cents higher than where it is right now. I really don't care. I just made that up to keep it simple. But the idea is that it's not going to sell. It's not going to sell unless it can sell for $84.50 or better. Now, if the market goes down, then I'm just going to sit there. I'm just going to sit there and wait and wait. The market, the limit order will be sitting there waiting to go. If at any point in time the market hits $84.50 for this particular fund, and if the brokerage firm has enough trading execution quality and capability, they'll get that order through. So that's why that's why I like using big firms like Schwab, TD Ameritrade, Fidelity. Some of the smaller firms make me a little nervous if I really want to get better pricing. Most of the time, these firms can get a little bit better pricing. But anyway, okay, so if I have a limit order at $84.50, it's going to place at that or better if I'm trying to sell. If I'm trying to buy it, let's say I was saying I wanted to buy this fund that's currently at $84.35. I could say, okay, I want to buy it at a limit price of $84. That means it will not buy unless it can get it to me at $84 or better. And in this case, better is lower. So $84 or better, meaning if it was anywhere in the 83 range, that order is going to happen immediately. If it hits 84, it'll happen really quickly. But if it sits here at 84.35 and goes up, I'm totally going to miss out and I won't buy in. So there's your risk on buying with limit orders. It might run away from you and you might not be able to get in. And there can be some psychology here. And I've done this. I've placed limit orders thinking, I can get it at just a little cheaper than where it is, or I'll just experience the normal volatility of this thing and be able to buy in. And I missed it and it ran away from me. And it happens every once in a while. Okay. So a limit order, that price or better. Stop orders are the exact opposite of a limit order. This is counterintuitive, but a stop order is, I want it to execute when the price gets worse. And you would think, why in the world would you do this? Well, the word stop is actually really helpful here. The word stop is like stop the pain. So let's say that I own this $84.35 shared fund, and I want to place an order to get out if things are going down and getting worse. And I always love it when people say, oh, the stock's going down or the stock's going up. You have absolutely no idea which way the stock is going. The stock has been going down, or it went down in the past, or it's gone up in the past, but no one has any clue which way it's going, especially in the short term. But the point is, if you do want to limit the loss, a stop order, so if you want to stop the loss, a stop order will get you out as it declines and hits a lower price. Let me give you an example. Let's say that you said, you know what, I really want to get out if this thing hits $80 a share, only $4 less than it is, I want out. If you place the limit order at $80 to sell, like if right now, I'm in here right now, if I place a limit order at 80, it's probably going to sell first thing in the morning tomorrow. And that's because the limit order says 80 or better. So if it opens up at $85, it's going to sell because 85 is better than 80. So again, limit is this price or better. Stop is when it gets worse to this price. So if I really want to hold it if it goes up, but sell it if it goes down to 80, that's a stop. So in this case, if I was really stressing and thought, I'd like to hold it, I think it's going to go up, but if it goes down more than about $4, which is like 5%, so that's nothing. But if it goes down more than $4, I want out. That's a stop order. I would place a stop order at $80 a share, and that would execute if it hit down to 80. So the last one on the chart that we're talking about is a stop limit. And it's the combination of the two. So it's still when it gets worse to this price, the only difference is instead of just converting that stop order to an immediate market order and placing it right away, it converts that stop order to a limit order. So it says, okay, when it goes down to 80, I want you to trigger and get me out. But I only want to get out if I can get it for 80 or better. So it's like a two-step. It's like you change it. It's almost like changing your opinion right there in that moment. You say, okay, when things get really bad, if they get worse, I want out. But at that moment, I want out, but I want to get out at this price or better. And so it can be a little tricky because if the stock blows through 80 and goes down to 75, you may never sell because the brokerage firm may not have the time. If it blows past the price too quickly, they might not have the time to trigger the order as a stop and then immediately get that limit order back in at 80 to try to fill at 80 or better. So anyway, that's a stop limit. Now, there's in this chart that we're seeing here, there's also what's called a trailing stop loss. I am going to go over this really quickly, but if this is your first stock trade, or if this is your first entry into this, do not be messing around with trailing stop orders just yet. They're really not that risky. In fact, they can limit risk, but you just want to get used to market and limit and stop orders. In fact, I would just get used to a market order during market time, place the order and be done, or maybe a limit order and try a few there, and then move on to stop if you really want to, and then trailing stop loss. So a trailing stop loss order says, I want to trail the stock as it rises by a certain percent or a certain dollar. And your order will trigger if the stock drops by that trailing amount. So an example here, $84.35. If I set a trailing stop loss of $5 below ITOT's price, I have a stop order sitting at $79.35. That's $5 below 84.35. If the stock goes up to 100, my stop order is going to climb up with it, and it's going to be 95. And as soon as it drops down and hits that trailing $5 band, then at that point, it sells. Think of it like a rock climber that's doing a lead climb. You know, when they do that lead climb, they may have some eye hooks that have been drilled into the cliffside, but they have a massive number of carabiners attached to their harness, and they're climbing up. It's kind of like a rock climber, like as this rock climber's going up, is hooking in carabiners like obsessively, like every couple inches along the way. And as he goes up, he's hooking in carabiners like crazy, and he has a certain amount of slack in his rope. And in this case, the slack in his rope is like $5. So if he falls that far, it catches and the order is triggered to get out. It's very much like a lead climber. I think that would hopefully help make sense. Anyway, that's a trailing stop loss. Moving on. By the way, you can do trailing stop orders to buy. That's even more messing with your head a little bit, where you're thinking, okay, as the stock is going down, I've got this buffer above, and if it climbs up through that, I want to buy. Anyway, stop orders in general on the buy side, you really have to think that through so you don't mess up. Okay, time in force is the next option I have to pick. And so, by the way, I set a limit order at 84.50. I guess I'm trying to get an extra 15 cents out of this thing. I don't know why, but we're just doing it. And then time in force, you can pick day or good till canceled. Those are the top two normal, the most normal. If you do a market order, it's always day. But if you do a limit order, you could do good till canceled. I'm going to do good till canceled just for fun here. And and then it used to be that it was like 90 or 120 days. But brokerage firms have now got it to the point where you can pick the day. And so I'm going to, and it's letting me go out 6 months. So I'm going to set this for December 31st because I really want this to happen sometime this year. So I really have about a 2-week window. So it's good till canceled, but it's canceled in 2 weeks because I picked the date that I want it canceled. That's what that means, good till canceled. And then I'm going to set, and these other ones, just forget about them. Fill or kill, immediate or cancel, or on the open. None of those are really that helpful. They basically are old school ways of like testing out the trading pricing and place the order or get it out of there. I don't want to, I don't know. I've never used them really. Day and good till canceled are always plenty. Okay, so next step is conditions. This one's also one where you don't really need much. Just do none most of the time. Do not reduce has to do with ex-dividend dates. So if this stock is going to distribute a dividend, they have a date on which they lower the price of the stock by the dividend amount. And that kind of sounds crazy, but it's really pretty smart, because if they don't lower the price, imagine, dividends have to be forecasted. They have to tell everyone exactly when they're going to pay a dividend. And they say, okay, if you own this fund or this stock on December 13th, you're eligible for the dividend. And then another quarter later, we'll do another one. Well, here's the problem. If that was all the story was, then you and I, we could go in there and say, great, I'm going to buy this fund on December 13th and another one that's paying on the 15th. I'll sell this fund and buy the other one on the 15th, and I'll just chase dividends around. You could make like 50% return on your money in just chasing dividends around and not really being a long-term investor and owning the stock and receiving the benefits of the company's profits through dividends. It's just not the way it was designed. So in order to discourage dividend chasing, they take the stock price and they lower the stock price by the exact amount of the dividend on the day around the record date, is what they call it. So they have what they call an ex-dividend date. So anyway, if you tried to chase dividends, basically what would happen is you'd get the dividend, but your stock price would go down by the same amount, and you'd have a wash. And even worse than a wash, you'd have the same thing you had before, but now you have to show the dividend on your taxes. So it's really not helpful at all. So the do not reduce in the conditions that we're talking about in this last drop-down menu is do not reduce my order price. Like if you have a limit order in there, which I do not reduce it for a dividend adjustment, which means the dividend adjustment itself could trigger your order if you do not reduce. But if you leave it at none, then it will adjust with the dividend adjustments. So I just left mine at none. I think that's fine. So now I'm going to hit preview order, and it gave me a warning. It says, hey, the price of the selected security will be impacted by an announced dividend of 34 cents. So there it is, ex-dividend happening to us. Totally fine. I really don't care. We're just trying to get this order through so you can see it. So then before you place an order, you really want to make sure you do a couple of things. One, check the value of this. So selling these 24 shares or so is going to work out to be about $2,028 worth of the fund. And that makes sense to me. The fund has gone up like 70 something percent since I purchased it. And which, I mean, that sounds great too. That's good. Anyway, up 70% since I purchased it, and I'm trying to show about 900 and something dollars worth of gain. So this particular piece has actually probably gone up a little bit more than that. They call them a lot. Each individual purchase of a certain number of shares on a certain day is a lot, an LOT, lot. But anyway, the smell test looks good. I mean, basically, you want to make sure it passes does this thing look right? Check. Like you look at it and say, does all of this make sense? I mean, I've got 84.35 is the price. Am I placing a limit order at 84.50, meaning I'm trying to be greedy apparently and get 15 more cents. It'll expire, it says, on December 31st at 4 p.m. Eastern when the market closes. Great. I mean, all reality, what's going to happen is tomorrow morning, I'm going to hop in here. And if this thing hasn't already filled, I'm going to go in and I'm going to cancel it and place a market order just to sell it. And then I'm going to take the $2,000 and I'll probably buy mostly back into this fund. But I am thinking this account has maybe a little bit too little of small cap and international. And, it's only 6 years. So I'm going to be thinking a little bit about that tomorrow. I hadn't, for whatever reason, I was thinking I had another decade with this young lady, but I don't. So at 6 years, I usually start to get maybe some of the money a little bit more conservative, but I probably won't put more than 10% of it into something conservative. But anyway, the goal is I've got plenty of money going into this over the next 6 years or so, that if I want to put new money more conservative, that's fine. But okay, I'm going too far. But basically, I need to take the 2,000 and then I need to buy something back tomorrow after it sells. I'm really just trying to show the gain to sneak it in. So I just hit place order on that one. So I'll get a notification on my phone and watch, and it'll tell me, hey, the order's been submitted, and I can check the status usually on the order page and see how it goes. And that is placing your first stock trade. So I'm going to review that really quick so that if you thought, oh my gosh, that was a lot, because after we got done, I thought, oh my gosh, that was a lot. Okay, forget about all the tax stuff. I just tried to give you context as to why in the world I'm placing this seemingly unimportant trade. Let's just jump straight into the trading. Transaction type. Are you doing a stock trade, an exchange traded fund, or a mutual fund? And stocks and ETFs trade the same way. Symbol. This is the ticker or the symbol for the stock, fund, or mutual fund. Then you move on to action. So are you buying or selling? Believe it or not, I used to get a lot of calls when I was answering and helping with trades, and people call in and say, hey, I was trying to place this trade and it didn't go through. In fact, I have more cash than what I thought I had before. And it's like, oh, you actually sold stuff instead of buying stuff. And that is surprisingly common. And so anyway, just double check. Are you buying? Are you selling? Are you going to sell all the shares, or maybe are you going to choose specific shares for tax reasons? Remember, the coding for mutual funds is about 5 letters with an X at the end. Stocks and ETFs could be 1, 2, 3, or 4 letters. Of any letters, the X's don't apply there. And then moving on, market orders, limit orders, stop orders. These are order types. Start with market, limit. Maybe think about stop if you're trying to get out to limit losses. If you had a stock, like you bought an individual stock that just took off and did really, really well, and you're thinking like, I'd really like to enjoy this ride a little longer, then you could place a stop order to say like, yeah, but if it goes down, I really want to lock in that gain and take it out, and I'll be happy. That's a stop order. And that's also a trailing stop order. So if you don't want to have to log back in because the stock went from $85 to $200 and you have this stop order sitting at 70, and 70 no longer makes any sense for a $200 stock, you could log back in, you could cancel the $70 stop order and move your stop order to now 180, or you could do a $10 or $20 trailing stop loss, or a 5 or 10 or 15% trailing stop loss, and let the system do the work of tracking it up and moving your stop order up with the price. All right, and then time in force, that's the day or good till canceled. And then conditions, most of the time just leave it at none. If you're really stressing about, or if you want to have that price stay, even if a dividend is moving the share price that day, then do not reduce. Get through the does this look right test, and before you place the order, read the warnings up at the top, see if you can understand what it says. Don't be afraid of this. Start small. The really cool part about all of this is you're seeing on the screen right now, $0 commission. Back when I started, this was expensive. And when I was putting $50, $100 in a month and it cost $10 to buy, I'm thinking, oh my gosh, I am 20% in the hole before I even get started. And now it's zero. It's amazing. It can be done by anyone with any dollar amount. I'm literally placing a trade here with money that I put in at $50 a month, and I'm not paying any commissions to get out of this thing, and I'm not going to pay any commissions to buy any funds back. So don't be intimidated. Check this out on YouTube or thefinancialcall.com. Let me know if you have any questions. Let me know if there's something else like this that you'd really like me to just break it down, like my friend says, sesame simple. Thanks for listening.